In the 12 months to the 20th of August, the Federal Reserve added $342 billion of Treasury bills to its own balance sheet without anyone treating it as news. That is roughly a third of every new Treasury bill the United States issued in that entire year. For most of the same week, the bond market was arguing about something else, because Scott Bessent had doubled the ceiling on Treasury's long-end buyback operations, and the coverage settled within a single day on one story that everybody then repeated. The story was that Treasury is suppressing long yields while Kevin Warsh fights inflation, and that the two arms of the American state are therefore colliding in public over who controls the long end of the curve. So here is the question this film exists to answer. If two institutions really are fighting each other, which of them is actually moving the larger amount of money, and does the fight show up anywhere in the flows at all? The consensus deserves stating at its strongest first, because a departure from a weak version of it is worth nothing to anyone who holds it. Treasury exists to finance the government at least cost over time, and is not supposed to hold a view about the level of long rates at all. When it announced that it was increasing its liquidity support buybacks by at least double in the 10 to 20 year and 20 to 30 year sectors, it was unmistakably announcing a view. Bessent has said publicly for 2 years that he cares about the 10-year yield, and the 30-year bond had just printed above 5.25% for the first time since the financial crisis. Warsh had told reporters almost the opposite thing only weeks earlier, saying that the rise in longer-term government borrowing costs served a valuable purpose by tightening financial conditions in an economy where inflation was still running at 3.4% against a 2% target. So on the surface, one arm of the state appeared to be deliberately unwinding the tightening that the other arm was openly relying on to do its job. That is a coherent story, and every single element of it is checkable against public documents. 2 of those elements turn out to be wrong. Start with the instrument everybody was watching, because Treasury publishes its tentative buyback schedule at every quarterly refunding, and anybody with a browser can open the file and count the operations for themselves. Inside the exact window, the doubling covers, which runs from the 9th of September to the 4th of November. There are 7 long-end operations scheduled, and no more than 7. 7 operations at a $4 billion ceiling is $28 billion of maximum capacity, measured against $14 billion at the ceiling that existed before. So the doubling that the entire market spent a week pricing buys the United States Treasury $14 billion of additional room, and it buys that room across a period of 8 weeks. 2 further details on that same schedule matter considerably more than the headline number does. The column marked minimum purchase amount reads 0 on every single line of the document, which means these are ceilings rather than commitments, and Treasury remains under no obligation whatsoever to buy anything at all. And the doubling carries an expiry date, because a permanent program for suppressing long yields does not usually arrive with an 8-week sunset printed on the announcement. There is also a detail nobody mentioned. On that same published schedule, the cash management buybacks in early September carry ceilings of $12.5 billion each in the 1-month to 2-year sector, which makes Treasury's largest scheduled buyback operations of the quarter more than 3 times the size of the long-end ones everybody was arguing about, and puts them at the front end of the curve. The market itself answered the narrow question inside 2 trading sessions. The 30-year bond closed at 5.28 the day before the announcement and at 5.19 on the day of it. By the 21st of August, it had closed back at 5.27, which is 1 basis point from where the whole episode started. So I went looking for the other half of the collision, and I expected to find a central bank balance sheet visibly shrinking while the Treasury bought bonds, because that is the picture almost every account of this week was painting. It is not there. What I did instead was pull both weekly balance sheet releases exactly a year apart and difference the lines myself, which takes about 10 minutes and requires no terminal. On the 29th of October last year, the Federal Open Market Committee decided to cease the runoff of its securities holdings entirely, starting from the 1st of December. In the same decision, it directed the trading desk to roll over at auction every dollar of maturing Treasury principal, and to reinvest all principal payments received from its enormous holdings of agency mortgage securities into Treasury bills. That second instruction is the engine of everything that follows, and it is worth reading slowly. Every single dollar that comes back from the Federal Reserve's mortgage book is now automatically recycled into Treasury bills, and that book throws off principal continuously as American mortgages amortize and prepay, which makes the whole thing a standing mechanical bid that requires no further decision from anybody in any given month. Then in December, the committee went considerably further than that. It directed the desk to increase its securities holdings outright through secondary market purchases of Treasury bills in order to keep bank reserves at what it called an ample level. The first monthly schedule was approximately $40 billion of bills. In the monthly period immediately before it, the desk had conducted no Treasury operations whatsoever. Schedules are only plans, and the weekly balance sheet is the receipt. Bills held outright went from $195 billion on the 20th of August last year to $537 billion on the same week this year. Total Treasury holdings rose by $340 billion across that identical window, while the bill line alone rose by $342 billion. Which means bills account for more than the entire growth of the Federal Reserve's Treasury portfolio, because the coupon book barely moved at all and the inflation index book actually fell. The mortgage book fell by $186 billion over the same period. What that describes is not a balance sheet shrinking, but a balance sheet converting mortgage duration into front-end government paper. And total assets rose by $127 billion across the very year in which Kevin Warsh was being described almost everywhere as the man who was shrinking the Federal Reserve's balance sheet. He was not shrinking it. It grew under an instruction that was issued before he ever took the chair. Now set that against the supply side, because a large purchase means very little until you know what it was bought out of. Treasury bills held by the public went from just under $6 trillion to just under $7 trillion over the year to the 31st of July, which is roughly $993 billion of net new supply arriving into the market. The Federal Reserve took down approximately a third of that entire amount. Its share of the outstanding stock of Treasury bills moved from about 3% to nearly 8% inside 12 months. A third of the marginal supply of the world's most important short-term instrument, absorbed by an institution that describes the operation as purely technical. Here is the part that I think is genuinely mispriced, and it has almost nothing to do with the 30-year bond. Treasury's operating cash sits in an account held at the Federal Reserve, and that account is itself a Federal Reserve liability, which competes directly with bank reserves for room on the liability side of the same balance sheet. When the account falls, reserves rise dollar for dollar. That account held $933 billion in late August, and Treasury's own borrowing estimates assume something close to $950 billion at the end of September. Now read the trading desk's published sizing rule, which states that its purchases are sized to accommodate projected trend growth in the demand for Federal Reserve liabilities, as well as seasonal fluctuations. The Treasury General Account is one of those liabilities, and it is comfortably the largest volatile one, which means Treasury's own cash management decisions are a direct input into how many Treasury bills the central bank buys in any given month. I am not inferring intent anywhere in that sentence. That sizing rule is the desk's own published methodology. Watch what the schedule has actually done across this year. The discretionary purchases ran at $40 billion a month through the first quarter, then stepped down to $25 billion in April, then to $10 billion, and for the current monthly period, the desk plans none at all. Meanwhile, the mechanical mortgage leg has climbed steadily from $13 billion to $17 billion a month, and is now the entire program. And then there is the document that nobody covering this story appears to have opened. Treasury put a formal charge to its own Borrowing Advisory Committee earlier this year, titled Bill Purchases and the Consolidated Balance Sheet, asking that committee to assess to what extent Treasury issuance plans should be affected by expected Federal Reserve purchases of Treasury securities. The committee answered it directly, working from an estimate that the portfolio would grow by $540 billion of bill purchases across this year. It reported that the bill share of total issuance could rise from 21.6% to 23.2%, while the share of privately held debt represented by bills remained completely unchanged. I have read that passage several times, and I do not believe it can be read down. The bill share of what the government issues rises, and no private balance sheet anywhere has to absorb the difference, because the central bank is quietly taking it down instead. The committee even has a name for that bid. It calls it New Federal Reserve Policy Demand for Treasury Bills. The strongest objection to all of this is historical rather than theoretical, and it deserves raising properly. Treasury buybacks have moved yields before and moved them a very long way. Connolly and Strube put the buyback program of 2000 to 2002 at roughly 95 basis points on the bonds that were purchased and on similar maturities. Against a record like that, arithmetic about $14 billion looks naive. The rebuttal is entirely about the funding. That earlier program retired $67.5 billion of debt across 45 operations out of genuine budget surpluses, and total marketable treasuries fell from around $3.5 trillion to $3 trillion while it was running. Supply actually went away. Treasury is currently borrowing $739 billion of net new marketable debt in this quarter alone. There is a second objection that I can only half answer, and I would rather say so than pretend otherwise. Size may simply be the wrong axis. Mario Draghi never bought a single bond under the outright monetary transactions program, and it still compressed peripheral spreads by hundreds of basis points, because these interventions work through the implied promise rather than through the notional amount. My answer is that signaling requires credibility. that the move of the 19th of August round tripped inside 2 sessions, and that an announcement which ships with an 8-week sunset printed on it is close to the opposite of an open-ended commitment. That is a real answer. It is not a complete one. Now the part that cuts hardest against my own argument, because leaving it out would be dishonest. The flow is decelerating. The advisory committee modeled $540 billion for this year, and the desk's own published schedules are tracking nearer $360 billion. Discretionary purchases have already gone to zero. The mechanism is real, and the magnitude is running light, and I hold both of those at the same time. 2 further limits belong on the record. The surviving leg of this program is sized by mortgage prepayment speeds rather than by any committee vote. So if rates rise and prepayments slow, then this bid shrinks quietly with no announcement whatsoever. And the entire structure is one directive deep, which means it can be rescinded at a single meeting. So here is precisely what would change my view, and both of these tests resolve on public data within weeks. If the desk's next monthly schedule shows reinvestment purchases materially below $17 billion, then the mechanical bid is shrinking, and my mechanism weakens considerably. And if the weekly bill line flattens or falls through the autumn, the central bank has stopped being a structural buyer, and this entire argument expires with it. If you take one thing from this film, take the number and the mechanism together. The Federal Reserve absorbed roughly 1/3 of net new Treasury bill supply over the past year, and the size of that bid is set by mortgage prepayments rather than by monetary policy. The risk to central bank independence is not that Walsh gets bullied into cutting rates. It is that the operating framework already made the institution a mechanical financier of short-dated government debt. Nobody had to collide with anybody at all. The plumbing did it quietly, on an instruction issued before the current chairman arrived, sized by a variable his counterpart at Treasury controls, while everybody argued about the 30-year bond. The full working, including both issuance scenarios end-to-end, is in the written research. Links are in the description.